A very good evening, ladies and gentlemen. My name is Ridhima Wali, and I extend a warm welcome to each one of you to this very captivating, intriguing, and most importantly, a very relevant platform called the Business Standard Insurance Roundtable 2020. I'd like to call on stage Mr. Shamal Majumdar, Editor, Business Standard, to render a welcome note for all of us.
We have completed 20 years of insurance industry opening up to the private sector. The foundations for a buzzing life and non-life sector was laid in 2000. So it's a good time to pause and reflect. The early years were about establishing the business, getting the wallet share of a market that had only dealt with government firms, issues of underwriting, distribution, disclosures, mis-selling, and changing regulations. The next 20 years will be crucial as the industry matures and deals with a changing demography, technology, regulation, and market order. Issues of fraud, risk of the unexpected externality in the business, and the millennial mind are some of the issues that the next 2 decades will grapple with. Our roundtables today is set against this backdrop. Lessons learned in the past 2 decades and the key disruptors and game-changing initiatives that will dominate this space for the next 20 years.
Let me call on stage our illustrious and noteworthy panel members, beginning with Mr. Bhargav Dasgupta, ICICI Lombard, Mr. Anup Rao, Future Generali, Mr. Anuj Gulati, Religare Health, and Mr. Sanjay Kedia, Marsh India. And the person who is going to maneuver and facilitate these discussions is going to be Mr. Tamal Bandyopadhyay, Consulting Editor, Business Standard.
We are going to discuss how the rules of the game have changed post-budget. And that was the time the insurance industry, if I may say so, lobbying hard with the finance ministry for raising the FDI, FII limit from 49% to 74%. So many of them thought that this is going to happen, but what exactly happened is completely different than what was the expectation. Some numbers, where do we stand? Indian general insurance industry, number 4, not in the world, in Asia. Till 2001, when the industry opened up, the CAGR is about 17%. Industry size is 1.7 trillion. And in terms of percentage of GDP, it's less than 1% of GDP. It's half of China. Global average is 3 times India. Probably last week, IRDA chairman said that you guys survive on your investment income. When it comes to underwriting, it's all losses. So with that, not a very pleasant thing, I'll start with you.
Obviously you cannot disagree with what IRDA chairman said. And one way of looking at it is you've made up the underwriting losses through investment income. But the real story is that if you look at the profit after tax of the industry in the same 11 years, it's actually become 1/4. So top line has grown at a compound annual growth rate of 17%. The bottom line, which is profit after tax, has reduced by 12% compounded. So the point is that if you look at any insurance business, in the long term, you have to focus on underwriting profits because that's the core of your business. If you take 100 rupees of premium, you have to make at least one rupee profit out of this, which means a combined ratio of 99. I think what will happen if we sustain this is that companies which keep on losing money will gradually become less and less relevant, and industry will unfortunately get more concentrated. Yeah.
So that's what Bhargav Dasgupta, the boss of India's largest private sector entity and the only listed entity, what you are saying is this predatory pricing will kill some of the players and consolidation will see.
The IRDA chairman is right in saying the predatory pricing will end up taking the industry the telecom way. I think that's the example he had used. But I think the fact is when you're fighting for market share, I think it's the laziest thing to do, is to compete on pricing or to compete on commissions. And at some level, it also displays lack of imagination, lack of innovation, lack of customer focus. The issue is that we sell commodities, not a great proposition to the customer. So unless you actually revisit the way we look at a customer, this will continue to be a challenge. And frankly, it requires one irrational player to give out irrational commissions or price irrationally for maybe the second player to follow suit, then a third, then a fourth, then a fifth, and so on and so forth. So it has a domino effect. And then you see that in all markets and all segments all over the world. I mean, you have a lot of companies who have tried to do that. I think this problem will persist. So if we continue to be lazy about this, we'll have a larger problem.
Thanks, Anup. Thanks for being so candid. So, gentlemen, we heard about lazy banking. Now, Anup is saying is lazy insurance, no imagination, nothing. You just, you do the same thing in a mechanical way and cut down the prices. So, what's your take? You are primarily in the health.
Yeah.
Where is the scope for innovation is much more.
As a country, give or take, we spend close to about 6 lakh crore rupees a year on healthcare. Health insurance this year will be about a 60,000 crore business, right? And in a lot of developed markets, most of this spend is either financed by the government or comes in from private health insurance. So there is a huge funding gap in India for health insurance. Underwriting profits are the only way to build sustainable businesses. So while there is a lot of work we need to do collectively as an industry, because I think if we work together from a supply side, and I keep saying there is demand, most customers are willing to buy, it's our inability to supply or to make available products at the right price in the right way to the customer.
But Sanjay, you are different from them because they are the insurers, you are, what should I call you, intermediary, that's the right way, right?
Represent the policyholder.
Yeah, representing policyholder, but primarily corporate India, right? You are not into the retail segment.
The corporate India, we serve close to say 5,000 corporates alone in India. And when we talk to them, what the policyholder says are these couple of things. One, they're asking for innovation in the coverage. So the coverage improvement in India with regard to the corporate India has not really happened. So regulator has allowed freedom in coverage to the insurance market last couple of years. But the insurance market has to take up this opportunity to start giving tailor-made coverage for different industries. But what has happened in the last couple of months is a very big shock to the corporate India. At one hand, they are going through a downturn. There has been a change in terms of a GIC-led reinsurance circular, which makes the pricing of property insurance on an average for good risks in India by minimum 2 times to as much as 10 times. So the corporate India got used to competition in pricing for last 10 years, but effective 1st Jan and the biggest renewal coming in 1st April, corporate India is going to be faced with no competition in the insurance pricing on the property rates. So they are forced, for example, pipeline, roads, they don't want to have a full coverage for the whole thing. So many corporates are in fact talking about that they don't want to buy insurance. So there was, and many corporates are discussing this, and this is a major development. And they're also complaining that the experience of them on the claim speed settlement for the Indian market has not been strong and good enough.
But Bhargav, just your quick reaction before we get into the next round is this. He said that corporates will, the companies will not renew because of such a steep hike. Is that correct?
We'll have to watch the numbers for April because that's when the biggest renewals happen. But there's a bit of a precedence to this because I think as Sanjay said, over the last 11 years in the property segment that we are discussing, prices have dropped by more than 90%. And I don't think in India you've seen anywhere, any segment where the prices have collapsed to the extent that it collapsed. And I think for corporate India, one of the biggest issues has been cost of doing business. And on the flip side, on insurance, I think Indian rates are less than half of global rates, even after the increase.
Of this, IRD is the third regulator globally after Singapore and UK, and globally is recognized as an extremely progressive regulator which is experimenting with regulatory sandbox. And demystifying what is regulatory sandbox is actually allowing you to experiment and experiment live. In the sense, certain things are not allowed by the regulator, but if the experiments succeed, the regulations will be tweaked, regulations will be changed to allow you that product, right? So with this, so can you give a sense where are we in this, if I may call it, in the insurance lab at this point of time?
Given more new digital mobile technologies allowing for new product constructs as well as new distribution methodologies or distribution avenues becoming available, I think that's where sandbox becomes even more interesting.
Can you, if it's not confidential, can you give us one product that you guys have recommended, your company is experimenting? Or
4 approvals, and I can talk about a couple. One we are doing is
most interesting one.
Yeah, the friend assurance product is about where we can go to a set of, so let's say a group of cyclists who regularly cycle together. We believe that nature of the risk there would be a little different from the normal risk, because these are people who are wanting to keep fit on their own and so on and so forth. So collectively for the group, we would be able to design and price the product differently.
Pilot, but there's one product we have, so we sell insurance in sachets, and let me explain what I mean by that.
Yeah.
So at Future Retail, which is our promoter, our shareholder, so at Big Bazaar stores and all the Future Retail stores, we actually sell sachet products. A customer while checking out of the counter can actually buy contents insurance. Somebody who's shopping can actually pick up a sachet and say that, buy a product to protect himself or herself from mosquito-borne diseases. We call that a vector product. So here the innovation really has been on the channel of distribution more than products, because I think we were told by all and sundry that this will never work because, shops don't sell insurance. I mean, banks do, agents do, motor dealers do, but in the last 9 months, you have sold 1 million products.
So one of the things that I think as a country we should worry about is road safety. Because India is the accident capital of the world in terms of number of deaths that we have on the road. And unfortunately, over the years, we've not been able to design products that incentivizes better behavior. So one of the products that we've got approval for is a motor insurance product where you pay your premium based on the quality of your driving.
if you can tell us, how do you decide the quality of driving? Like how do I drive?
Depends on the speed at which you drive. Sharp braking, sharp acceleration.
So you put something on the car. There is
a OBD device that tracks the quality of your driving, and we even give you a score at the end of this trip, saying that this trip you scored. Your driving score is this, and if your driving score is poor, your premium will not go down. If it's good, in the long term, premium will go up.
So you fix that device on my car, to my car.
To your car, exactly.